Yes. Yeah. So let us start with today's session, uh, that is Introduction to Financial Management. Okay. Now, can anyone tell me what is financial management according to them? In your own words, what you all feel financial management is, or what is the scope of financial management? What exactly does it cover? Can anyone tell me? I'm sure some of you all will be business management students who have studied this subject before. So I want you all to answer in your own words what financial management is. Don't worry.
Good morning, ma'am.
Good morning, Alfia.
Alfia. Yeah, ma'am, financial management, it basically focuses on managing the financial resources like various funds that we collect via borrowed funds or our reserved earnings. It is basically focusing on how we manage our financial structure of a company.
Excellent. Yeah. So as Alfia told us, financial management, it deals with managing the funds of the company, basically taking care of all the financial aspects or the financial decisions related to an organization. Now let us start. Let us understand what is financial management with the help of this scenario. Some of y'all are having, I guess, some internet issues. Y'all are leaving and joining again. Okay, let us continue. So let us understand what financial management is with the help of this scenario. Okay, there are four stages over here with which, a financial manager takes his decision. So this is the process, the thinking process of a financial manager. So first stage, he decides which assets to buy. As we know that all resources which are available to us, not only an organization, but to us as humans as well, are limited. They are scarce. They are not available in abundance. So even finance, which is there, right? Money, okay, it is limited. There is nothing such as, abundance of money available, that even as we as individuals, even your parents, they might, prepare some budgets as to how they are going to spend their resources, that is how they're going to spend their money for this 1 month. So even though they earn, even though they have enough money, there's always going to be shortage, because money is a resource and all resources are scarce. So it is very important to decide which equipment they want to buy, because they cannot go on a wild spree spending all their funds on buying machinery, right? A organization has different uh, ventures where they have to invest in. Now they cannot just go on purchasing machinery, because machinery, it gets obsolete after few years. It becomes, you know, old. It depreciates. So you just cannot spend all the finance that you have raised on buying machinery. So they have to decide what machinery they have to purchase. They will decide whether to, and even if they decide how the machinery, they will also decide the quantity with which they are going to purchase the machinery, whether to go for purchasing of two machineries or one machinery. So that is stage one. In the stage two, what is happening is the financial manager is determining what is total investment required for buying those assets. In the first stage, they decided what machinery they are going to buy, maybe the type of machinery, the quantity of machinery, all that. And in the second stage, they are determining how much investment, that is funds, they will need in order to buy that machinery. In the third stage, Manjusha is having a issue, I guess. She's leaving and joining again and again. Mm, okay, let us continue. Stage 3. In the stage 3, the next aspect also comes into picture, because apart from buying the assets, the organization also needs some cash or some money to run its day-to-day operations. Now that is called as working capital management. That is what I told you. Funds are there. A company will have crores of rupees, okay, but it's always going to be scarce. It's always going to be less. So you have to take all your decisions and allocate funds for all your decisions. So that's why we saw in the first stage, they decide which machinery they are going to buy. Maybe there will be a certain type of machinery that they want to purchase. Then how much quantity of machinery that they are going to buy, whether they are going to buy 10 machines, one machine, that is their decision. In the second stage, we saw that they are going to decide the investment, how much they are going to invest in buying that machinery. In the third stage, we saw that they are deciding how much funds they need in order to operate the daily operations of the organizations. That is the daily needs or the daily fund requirements of that organization. Now, daily fund requirements, it is for purchase of raw material, for paying salaries, then wages for workers, all that. That fund you require in order to keep your organization functional. That is nothing but working capital requirement. Now, in the stage 4, what another decision that a financial manager has to take is what sources of finance are they going to tap on. Now, there are different sources of finance which are available from where a organization can raise their funds from. One is the share market. They can go for, you know, uh, issuing shares, or they can go to the banks. So now the decision whether to go for equity capital or whether to go for debt capital or whether to go for both, but in a ratio like 50% debt or 50% equity, 60% debt or 40% equity, all that decision is taken in the stage 4 by the financial manager. So now you'll understood the stages with which the thinking process of a financial manager goes about with this. All these things from stage 1 to stage 4, all these decisions are taken by financial manager, and these decisions are nothing but managing the finance, that is financial management. Okay, now let us go one step further and try to define financial management. Now we saw the stages in which financial management operates. Now let us define it in simple words, like what financial management is, because all these things you cannot write for your exam that these are the stages and all. So let us define it in simple terms. Okay, y'all can also read from the slide. Financial management comprises of forecasting, planning, organizing, directing, coordinating, and controlling all the activities related to acquisition and application of the financial resources of an undertaking in keeping with its financial objectives. This is what Alfia told us, right? That it deals with all the financial decisions. That is what this sentence is saying. But it is also specifying what it comprises of. It comprises of forecasting. Obviously, you don't know the exact amount of expenditure that will be incurred by the organization. So obviously, there is some amount of forecasting that we are doing. You will see the forecasting aspect where it comes into picture once we start with time value of money. But there is a forecasting aspect because you cannot predict exactly how much of expenditure you are going to incur. Like for example, say your parents have decided that they are going to spend so and so amount for this month, but unexpectedly some event comes about with, like maybe your cousin is getting married or something like that. So that is a expenditure which they had not accounted for, right? They don't know exactly when a distant relative is getting married. They just inform you by giving you the invitation. So that is an unexpected expenditure accounted for. Now there is a wedding in the family, they'll have to buy something, like a little bit of added expenditure. So basically your understanding, it is forecasting in a sense when you decide how much expenditure you are going to bear for this month. You just forecast, but the actual expenditure can be completely different. That is, your parents decided that they are going to spend 20,000 this month, but go to see at the end of the month they spent 30,000 on the household expenditure because of your cousin's wedding, which they had not accounted for. So forecasting, it is forecasting. That is, you're just predicting what your expenditure will be for the next month. Planning, obviously you're predicting, and also you will plan where exactly are you going to invest, or where exactly are you going to spend the money on. Planning can be with respect to savings also, and with respect to spending also. Planning. Then coming to organizing. Organizing is nothing but in a way, uh, organizing the funds, which exactly into which department are you going to allot the following funds, because the organization has different departments, from purchase to marketing, personnel, right? Different departments are there, finance department, like different departments are there. So every department a certain amount of fund is allotted. So basically deciding that, then directing the usage of that funds which you have allotted, coordinating, all the departments have to coordinate in a manner in order to utilize the allotted funds effectively and efficiently. And lastly, controlling. Controlling is nothing but controlling your wastage, controlling your expenditure, basically that. So all the things, all the above things, they are related to financial aspect of the organization. That is basically all the above things: forecasting, planning, organizing, directing, coordinating, and controlling. All these things are applied to utilization of your financial resources. Okay, then the next definition is financial management is concerned with the managerial decisions that result in acquisition and financing of short-term and long-term credits of the fund of the firm. As I told you in the previous slide, we saw the different stages. The short-term as well as the long-term decisions with respect to finance are taken by the financial manager, and that is nothing but financial management. Okay, so to sum up, we can say that financial management is concerned with efficient acquisition. Efficient acquisition in the sense you it is also concerned with acquiring the funds, that is whether they are going to acquire it from the shares, or are they going to acquire it from borrowing it borrowings from bank, that is whether they are going to go for equity or whether they are going to acquire it from debt. So efficient acquisition, it deals with also acquisition of finance, also allocation of that funds, with one and only one objective, that is to make profits. I'll repeat again. To sum up, financial management is concerned with efficient acquisition, that is acquiring the funds, whether to acquire it from equity or whether by debt or by both, in, like 50% equity, 50% debt, like accordingly, and also allocating those funds in efficient manner with only one objective, that is profits. All the organizations, they are functioning with one goal, that is they need to have profits, and these profits can be achieved only and only when you smartly raise the funds from the market, and also utilize those funds smartly. That is the only time you will make profits. Why am I saying that? Even acquisition of funds is very essential. Acquisition of funds is very, very essential because for every mm, rupee that you raise, basically you have to pay a certain amount of interest, because no one is going to give you anything for free. Everything has a certain price. So obviously, every rupee that you are raising from the market, be it from equity, be it from debt, you have to pay some interest. In case of debt, you will have to pay some interest. In case of equity, you will have to pay some dividends. No one is going to invest in your company until and unless you are going to benefit them by giving them some return, that is by interest or by dividend. So that is the reason why there is always a cost of raising funds, so that your profit will depend on the cost with which you raise your funds. We'll discuss this in detail, but for now, I just ventured into it, but we will see this in detail. I will take you all slowly, slowly towards it. For now, you all understood the meaning of financial management. It is nothing but efficiently raising funds and also utilizing those funds efficiently. Both, that is acquisition of funds efficiently and utilization of funds efficiently. If these two things are done, then only there will be profit in the organization. So if tomorrow if I ask you all what is financial management, this is what I want from you all. That is efficient utilization of funds and efficient acquisition of funds with the sole objective of making profits. Simple words. In the paper afterwards, you all can write all these things. Aspects of financial management. There are two aspects of financial management which we just discussed. The first is procurement of funds, and the second is utilization of funds. Procurement of funds is nothing but raising funds. As I told you, there are different, we will go into depth now of procurement of funds. Now, funds, okay, procurement of funds, okay. So, since funds can be obtained from different sources, their procurement is always considered as complex problem by the business concerns. Now, there are different sources from where funds can be obtained by the organization. They are listed over here. See, first is equity, then is debentures, then is funding from banks, then is international funding. Now, these are the different sources which are available to the organization from where they can procure or raise their funds. Okay. Now, funds procured from different sources have different characteristics in terms of risk, cost, and control. Now, we will see in detail with respect to each source how they are different in terms of risk, cost, and control. But obviously, as we all know, if we invest in shares, right, it is more risky. But if we are opening a FD in a bank account, it is not that risky. Can anyone tell me why it is not risky to open a FD in a bank account, whereas it is very risky to invest in a share market or equity shares basically? Yeah, can anyone tell me why? Yes, I want you all to speak, otherwise I'll consider you all are sleeping. Yes, you all can speak in your own words. Even in Konkani, you all can speak. Okay, there is no such compulsion as such. As long as you are talking related to the subject, I don't mind. But I want you all to open up, to talk. Alfia is the only one talking.
Hello.
Yes, yes, Alfia.
Hello, ma'am. regarding FD, like if we invest in FD, it is we have a certain security. Means after certain period of time, we'll get the money back. But in stock market, it is like fluctuating. If certain company faces loss or certain international crisis happen, stock market falls immediately. And even if we have invested a lot of money, we end up getting a lot of loss. That's why it is safer to invest in bank in FDs rather than investing in stock market, as it is highly risky market.
Okay. Now, Alfie, I'll ask you
Yeah,
another
that's it.
question.
Okay,
Alfie,
ma'am.
yeah. Now, see, okay,
Yeah.
whatever you said is correct. Now, if you
Mm,
are going to invest in shares, okay, I'm giving you the money and I'm
yeah.
asking you to invest it in shares. So when you're investing it
Okay.
in shares, right, you
Mm.
will expect higher returns from the shares or less returns from the shares.
Oh, mostly higher returns.
Why you will expect higher returns from the shares?
Because in a stock market, if a company makes profit, so we have a chance to earn a bit more
Hmm.
than the usual amount.
Yeah.
That's why.
Okay.
And it's vice versa, like
Okay.
that. And
Yeah.
if it makes loss, then we are doomed. Like,
Okay. Yeah. Good. Yeah, good, Alfia. That's it. I expect others
okay,
also
thank
to,
you.
yeah, thank you. I expect others also to answer, okay? I guess 27 participants are there over here. I expect all the students to participate in the class. I can understand we are having a online class, but I need to know y'all. Y'all need to speak up, okay? I will have an introduction class mostly otherwise tomorrow so that y'all can, show your faces, let everyone know, who y'all are. Otherwise, it will be like you don't know me and I don't know you all. It's just some online course that we are doing. I want you all to interact. I want you all to answer. Even if it is wrong, I don't mind. I'm not going to shout at you all. It's a learning process. You all are learning. Okay, it's not an interview. I'll repeat again. It's not an interview. It's a class. You all can keep your views. If it's wrong, I'll correct you all. If it's correct, well and good. I'll appreciate it. Okay. So I expect you all to interact. Yeah. So as Alfia said that she expects higher returns from equity market and comparatively lesser returns from the FD. One of the reasons why she expects this is because when she invests in shares, she is bearing high risk. Investing in shares is very risky. So if you are investing in shares, you are taking a very high risk and as a result you expect higher returns from there. Whereas when you are investing in FD, it is not risky. It is not at all risky. It has very low risk because the term is fixed, the interest rate is fixed, everything is fixed. So you are not going to get anything more than what is specified in that FD of yours. When you make a FD, whatever is mentioned, that much only you will get, depending upon the term for which you are making the FD. So over there, you are having very low risk. As a result, you are not going to have high expectations from your FD that you're taking so much risk, you have to give me so much returns. That expectations won't be there. Whereas when it comes to share market, your expectations will be very high because the risk is very high. Now, since your expectations from the stock market is very high, as an investor now, from investor's point of view, we are discussing. As an investor, I consider share market very risky. As a result, when I'm investing in the share market, I expect them to pay a lot of returns back to me. So now from the company's point of view, let us see. From the company's point of view, the investors are going to expect a lot of return if they are investing in shares, in their shares. So the cost of equity is comparatively higher in that case, isn't it? Because I, as an investor, or Alfia as an investor, is expecting very high returns from equity shares. Now those returns, who is going to pay? Company, isn't it? So for the company, it is going to be a very high cost. So accordingly, each of these funds, like sources of funds, they have some amount of risk, some amount of cost, and some amount of control. With respect to equity, they are called as the owners of the company. They have some control over certain decisions of the company. So all these types of funds, they have some different characteristics with respect to risk, cost, and control. We will see that in the next slide. Moving on, the cost of funds should be at a minimum level. For that, a proper balance of risk and control factors must be carried out. Now obviously, whenever you are taking a loan, now even the company over here, when they are raising funds, they are borrowing, right? Some amount they are borrowing from the shareholders, some amount they are borrowing from the banks. Basically, they are borrowing your money. Now whenever you want to take a loan or wherever you want to borrow money, okay, most important thing that you will see is that the cost, just the interest rate that you will have to pay back, will be very less. You will go to a bank which is going to give you the least interest rate. The same thing the company should also do, isn't it? Because the company also is an individual, an entity, isn't it? So they also will take that only into consideration, that whatever funds that they are raising, they have to pay very less cost for it, that is very less interest amount in return. So that is the point. Then there should be proper balance between equity and debt ratio to ensure that the funding structure suits the business. Now, as I told you, nobody is going to go for 100% equity or 100% debt. There's always going to be a ratio with which they are going to go for equity and debt. It can be 60% debt, 40% equity, or 60% equity, 40% debt. Now, that depends on the company. That we are going to see in the further chapters, how you will determine which ratio of debt and equity a company should opt for. In the end, what should be the main tagline, or what is the main important thing? That your cost of raising funds should be less. So whichever option gives you the least cost of raising the funds, that option is usually selected. I have just 5 minutes over here. What I want you all to do is go to the chat room and type present. Don't leave. I will tell you all when you all can leave. Just go to the chat room and type present. Okay, some of you all are answering in the chat room also. Why your voice is so precious, that I cannot hear it or something like that, or I don't want other people to hear it. Huh? Syed. Syed has given the answer in the chat room. Don't be so shy, yeah. You all can always talk to me. Otherwise, I will start with some exercise sessions for you all. This is just the theory introduction. Okay, I have already uploaded a PDF chapter 1 on Google Classroom. You all can refer to it. Okay, if you all want more specific notes, I can send it to you all, but the chapter wise, I will upload the PDFs. You all can refer to those PDFs. When it comes to solving the problems, I will conduct a class, that is a normal class where I will explain the problems on the board and you all can see it through Zoom itself. So the problem solving will be that way. I will give you all the questions beforehand in a PDF format, and I'll be solving them in the classroom on the class board, on the board itself, and it will be visible to you all. So with respect to that, I hope I have cleared your doubts. Yeah. We'll continue this in the next class. Now only 2 minutes are there. And if I again send you all the link, you all will take 15 minutes to join. Next class, right? Immediately when I send the link, please join immediately. It takes around 15-10 minutes for you all to join. So just be on time. It's a request because it's a practical subject. We will need a lot of time. The homework for you all today is that I'll upload it on the Google Classroom itself. Few pages from that PDF which I have uploaded, you all will have to read. If you all have any doubts today with respect to introduction, I have gone very slow today because it's your first day. From tomorrow onwards, we can start in full swing. If you all have any doubts, I guess no one will have any doubts today because the only thing that I have covered is meaning. And the second thing that we have seen is procurement of funds, that too not completely. Yeah, any doubts? Then you all can ask me or else you all can leave. Yeah, you all can leave, students.